The trade war between the United States and China has been a source of anxiety for the global economy. On May 12, 2025, a ray of hope emerged from Geneva. After intense negotiations, the two giants agreed to a 90-day tariff reduction. The U.S. will lower tariffs to 30% on Chinese goods. China will reduce its tariffs on U.S. goods to 10%. This truce, while temporary, is a welcome development. It signifies a willingness to step back from a full-blown trade war. The world is watching, hoping this truce holds. The markets reacted to the news of the tariff truce with palpable relief. The Dow surged by over 1,000 points, a remarkable 2.5% increase. The S&P 500 and Nasdaq followed suit, posting gains of 2.9% and 4%. This euphoric response was mirrored globally. European and Asian markets rallied in sync with the U.S. The U.S. dollar strengthened against major currencies. Meanwhile, gold dipped slightly. The positive sentiment extended beyond the stock market. Brent crude oil prices rose above $65 per barrel. The technology sector saw significant gains. Shares of tech giants soared on hopes of a more predictable business environment. The market's reaction reflects the desire for stability and predictability. The tariff war has created uncertainty and hindered investment. The truce offers hope for a more constructive path forward. The tariff truce offers a much-needed respite for consumers and businesses alike, albeit a temporary one. The most immediate impact will be felt in the prices of consumer goods, particularly electronics, which have borne the brunt of the tariffs. Lower tariffs should translate into lower prices, providing a welcome boost to consumer spending. American businesses, particularly those in the manufacturing and agricultural sectors, stand to gain from renewed access to the vast Chinese market. The tariffs had significantly hampered exports, hurting bottom lines and causing job losses. The truce offers a window of opportunity to rebuild supply chains and regain lost ground. However, this sense of relief is tempered by the realization that the truce is just that, a temporary ceasefire in a much larger trade war. The 90-day window, while providing some breathing room, is insufficient to address the deep-seated structural issues that have led to the current impasse. The uncertainty surrounding the future of the trade relationship continues to weigh heavily on business sentiment. Long-term investment decisions remain on hold as companies await clarity on the trade front. The temporary nature of the truce underscores the need for a comprehensive and durable trade deal to restore confidence and unlock long-term growth. The 90-day tariff reduction is a high-stakes gamble, a fragile truce in a trade war that has already inflicted significant damage on both sides. The clock is ticking, and the pressure is on to translate this temporary reprieve into a lasting agreement. The stakes couldn't be higher. A successful outcome culminating in a comprehensive trade deal would be a boon for the global economy. It would usher in an era of greater economic cooperation and stability. The benefits would extend far beyond the US and China, boosting global trade, investment, and job creation. However, failure to reach a deal within the 90-day timeframe would be a significant setback. Tariffs could snap back to their previous levels, or even escalate further, plunging the world back into a trade war with potentially devastating consequences. The path ahead is fraught with challenges. Deep-seated mistrust and fundamentally different economic philosophies separate the two sides. The issues at stake extend beyond trade, encompassing technology transfer, intellectual property rights, and China's industrial policy. The next 90 days will be critical. Both sides must demonstrate a genuine commitment to compromise and finding common ground. The alternative is a descent into a protracted economic conflict that neither side can afford. The world is watching,